So when you look across any of the rich lists, you often see the profession hedge fund manager associated with eye-watering billions in earnings and wealth. So what are hedge funds? And why do their managers earn so much money? Let's find out. Hi, I'm Marcus De Silva and welcome to the Steps to Investing YouTube show, helping you beat low interest rates with simple tutorials and strategies that get you investing in the stock markets and earning a better return. Please like the video and subscribe to the channel and turn on notifications for the latest. Also send us an email if you've any questions. We'd love to help. My email is marcus@stepstoinvesting.com. So what do all these chaps have in common? Jim Simons, Ray Dalio and Bill Ackman. Well, they're all hedge fund managers and they're all worth many billions of dollars and each paid themselves more than $1 billion last year alone. Seen as the cream of the crop in the investing world, these fund managers employ sophisticated trading strategies that invest in diverse and unusual areas of the market to find a profit for investors. Those that employ strategies skillfully and make a lot of money for investors also tend to reap fat fees for their specialist work, which is why they can end up so ludicrously wealthy. Typically, hedge funds will charge a 2% fee per annum and then take 20% of any gains that are made. With so much money on the table, a few bad apples have also been tempted into juicy must-read scandals. Most notable are Bernie Madoff, who it turned out was not delivering big returns, but rather running a Ponzi scheme, and Raj Rajaratnam, a hedgie of the $7 billion Galleon fund who was dealing on inside information from buddies in high-up places. Now, hedge funds sit in the realm of alternative investments, and traditionally, due to their complexity, they have not been available to ordinary investors. But this is changing, as certain hedge strategies are replicated in funds that we as private investors can buy. Today, we're going to run through how these fascinating funds work and the types of hedge fund strategies that you can get involved in. So the first question might be, what are hedge funds and how do they differ from normal funds? Well, they're typified by their unusual and specialist nature of their investment strategies. Global markets are pretty enormous and complex, and there's many different assets and financial instruments and opportunities potentially available. For most funds, they tend to have quite a narrow set of rules though in what they can do with their investors' money, and they're quite tightly regulated. So, a UK bond fund, for example, is obliged to invest in bonds in the UK, regardless of whether its fund manager woke up one day, saw an achingly easy investment opportunity in, say, the shares of a particular US company and wanted to invest. They just can't. Hedge funds, on the other hand, have much more freedom in where they invest, as most are less strictly regulated. In effect, the gloves are off for managers to pursue all manner of strategies that wouldn't be considered as conventional, which enables them to make profits in different ways to traditional funds and potentially perform better when the latter is not. Where these strategies come from is very much down to the ideas of the fund manager and their knowledge of global markets and assets. Coming up with consistently profitable strategies is very hard to do, which is why the top managers get paid so much money. So what kind of weird strategies do hedge funds employ? Well, the big one is shorting shares. So most of the time, funds buy shares long, which means they buy them with the hope that the value will rise for them to then sell them and bag a profit. Shorting is the opposite. Through a process known as stock lending, investors profit when shares fall in value. This technique became particularly famed this year with the GameStop trading saga, which saw Reddit retail investors buy lots of the stock to drive up its price and cause the hedge funds who were shorting the stock to then lose lots of money. Collectively, they actually lost about $5 billion. A real stick it to Wall Street type affair. Shorting appears in lots of hedge strategies, and the notable one is funds that invest both long and short, and they're known as long-short funds, unsurprisingly. Another really interesting strategy in recent years has been the emergence of using algorithms to trade. The master of this is Jim Simons, who I mentioned before. He was a former code breaker for the NSA and mathematical genius. He decided to go into the investing business to go and earn some money and set up Renaissance Technology. Its flagship fund, the Medallion Fund, is the stuff of legend. Since 1988, it has returned around 66% per annum, of which no other fund has ever even come close to. Unfortunately, it's also only available to Renaissance Technology employees. Other specialist techniques you'll see in HEDGE include trading around unusual company events, such as mergers and acquisitions or bankruptcies, seizing on big global macroeconomic events and the impact that these may have on certain assets, also using lots of leverage, which means borrowings, to exaggerate returns, but this is very risky, or initiating very complex positions using specialist financial instruments known as derivatives. Okay, so what are the different categories of hedge fund? Very broadly, there are two types of hedge fund. The first are what they call non-directional funds or absolute return funds, which are trying to generate a positive return in any market environment. Importantly, this is not guaranteed though. These types of funds are more akin to what the original hedge fund was designed to do, to hedge the risks of a fund losing money. As such, these likely won't produce exceptional returns, but should also not lose too big either. The second type are the sexy ones associated with all those big hedgy names. They're known as directional funds, which means they're trying to post strong positive returns. They also tend to be much more risky and volatile. So why would you buy one? Well, for directional hedge funds, it's the potential for strong returns. With an absolute return fund, it's some protection against falls in the market. Although I must add that during times of real market stress, like during the pandemic, they will still fall in value. Hedge funds are also an alternative asset class, which means both also offer the potential for diversification from regular funds which hold mainstream assets like shares and bonds. This is useful as it's important for us to balance our own portfolios with lots of different types of investments to counter the risks of being in one market or asset class. Now, if you want to get involved in hedge funds, the ones that retail investors can buy are much more tightly regulated than the ones that professionals can buy, so the strategies might be watered down a little. These funds are regulated under something called UCITS, which is a European regulatory directive that details things like the allowable investments or the leverage a fund can use if it is to be sold to private investors. Popular funds here are absolute return funds if you're looking for slightly less risky investing, or in the racier directional space, you've got long-short equity funds, macro funds, funds of hedge funds, and hedge fund ETFs. Alternatively, there are a handful of investment trusts that you can see here on the AIC's website, which have much more freedom in using techniques such as leverage or concentrating holdings. Pershing Square Holdings, run by billionaire American Bill Ackman, is a great example, with its top 10 holdings representing 73% of the trust. Okay, in conclusion, hedge funds have lots of freedom in where they invest in comparison to regular funds. This enables them to find profits in unusual corners of the market. As an alternative investment, returns may be generated when those for mainstream assets are lackluster. Strategies available for retail may be watered down a little, but there are still plenty to choose from. Please click on the link if you want to catch the latest Get Investing magazine for lots of investment ideas. It's totally free, so please look at that and share it. Until next time, goodbye.